Good morning, Armor Insiders. Welcome to the morning meeting of our virtual hedge fund. I hope you guys had a good night last night. We had a great night. We've been fighting off the flu in my house, and everyone's waking up feeling a lot better. So cheers to that. And for Rebecca and I, seems like Tamiflu works for the caregiver. So log that one away if you ever have to deal with it. Anyway, hopefully I'm not speaking too soon. We're going to get to Honeywell in a minute. I got interrupted yesterday in my morning meeting, in our morning meeting, because of all hands on deck in the flu circus. So let's try to go over real quick some of the things I was trying to talk about yesterday and then update portfolio and whatnot. So first thing, just to go over real quick, we are making an obscene amount of money. Market right here, risk monitor green. We got past day 5, so now we're in day 6 of risk monitor green. And when we get past day 5 and risk monitor green's intact, probabilities suggest market will make its way higher. I don't know how long, how much, but probabilities increase if we get past day 5, and we just did it yesterday. So how does that affect my managing of risk? I'm going to give things more room. The most dangerous risk monitor green failure happens in the first 5 days. You get green and then it craters, and you have to get out of things quick. Now we're in that phase where things should work out. We should see prices that move higher. So we just got to go on a case-by-case basis. And as I was saying yesterday, you got to follow the Wim Hof way. You know, let the portfolio do what it's capable of doing. Wim Hof is all about cold plunging, right? And letting the body do what it's capable of doing. You're okay, he likes to say, if you guys are a Wim Hof guy. All right. And so what I'm saying is, with your portfolio, you're okay. You don't have to be on edge that something's going to happen in the next 30 seconds. Just take a step back. We're in that wonderful part of the investing cycle where all we're doing is managing success. So the cycle starts, you're 100% cash, max cash, risk monitor red. Then it flips green, and it's a flurry of activity and a lot of investment, which can be a little bit, a bit of a crazy feeling because you're putting a lot of money to work in the first few days. And every now and then that fails, and you have to take it all out. So you're on edge. And then you get to this phase in the cycle where you're getting it right and things are skyrocketing. And what you don't want to do is overmanage the portfolio, overtrade the portfolio, start jumping at shadows. There's a down day in something, and you assume that's the end. I got to sell because it's down for a day. You got to get away from that. I can tell you with a fair amount of certainty, I've been doing this 35 plus years. In order to have success, long-term success as a portfolio manager, you absolutely have to ride your winners. If you think about it, if there were successful investments all around you all the time, this would be easy. Everybody would make a killing, right? It's not like that. So the reason we're killing it right now, the reason we're riding giants, is because we did the right research, filled up our whiteboard with the right names, used algo entry points at key chart price locations closest to the stop. And we're in a market that's giving us an opportunity to make money, right? 8 out of 10 stocks follow the market. Market's crashing. None of those things will matter. Everything goes down. But the market's it's in a solid position, making a big base that's trying to break out of, okay? And the leaders are already leading. And that's what we're on. So you have to ride those winners, because it's not. So a lot of times the idea is, hey, I'm up for a couple of weeks in this idea. Let's sell it. Go find the next one. The next one's probably not as good as the one you're on. It's hard to find this. So when you uncover it, you got to ride it. The way I do that, the way I, go read Kipling's If. my dad's favorite poem, and I love it too. And it's a great poem, and you can go read that poem. Okay, if. And one of the lines in that poem is, if you could keep your head about you and everybody else is losing theirs, okay, you're going to be a portfolio manager, my son. Okay, so that's kind of where we are right now. And the way I keep my head about myself is just to follow a stop strategy. We know the strategy. We know it works. We know we're not going to top tick the asset. I'm not trying to top tick it because I don't know where the top tick is. Does silver stop going up at $100 an ounce? Does it go to 150? Does it go to 300? Who knows? So blinders on. Simple stop strategy. 14-day, 25-day, 50-day. A third, a third, a third. As long as we're above the 14-day, which is a pretty aggressive uptrend line, I just leave it alone. Let it go. Stop looking at, well, maybe that's a reversal. Okay, maybe it is. If it goes below the stop, then it was a reversal, and now I reduce my exposure. That's the process. Let the portfolio do what it's capable of doing. So that's the big picture thought this morning. Trade number 29 is in day 6 now. Okay, and we're going to get challenged. The stop is about to get challenged. In fact, it's gapping down right near the stop. So on the way up, we've had a series of these swing strategies try to go up, come down and test the stop, which sometimes is an unbelievably great day trading entry point as it grinds higher. So I don't know what's going to happen today. End of day, 355. If it's below the stop, I'm out. If it's above the stop, I'm in. The stop is around break even now. So, we've had a couple of starts and stops where we're right at break even, a little bit below, a little bit above. In the last 12 months, the strategy is accurate 63% of the time, and it had a huge year last year, even though it was 63%. 6 out of 10 made money. The other 4, we had to get out quick, and our average loss, it was like our average exit was around break even. So we're in another situation like that again. It might trip us. We'll get out around break even, give or take a small amount, let's say. It won't change the risk monitor. This is the most aggressive strategy, right? And it's going to go through periods where it does this a little bit more. It's going to have its biggest moves after a big decline. That's why we had a huge year last year, even though we were right 6 out of 10 times. Okay, over a 12, that was a 12-month period. I looked at this whole structure here, going back into here. That was a loss, that was a loss. And then we had all of these successes, okay? So generally, the strategy works best when it gets hammered the market, and then we get a trade on and it rips higher. These are always a little more tricky in here because we have a wicked tight stop. So just to be clear, if we get stopped out of this, it's not going to change the risk monitor. It's just going to be a little bit of noise in this strategy, and we'll just have to look for the next entry point. All right. Highlighted stock of the day, Honeywell. Honeywell, I'm going to go out there on a limb and say this might be the easiest money we make this year. I just jinxed it, right? It's going to go straight down. But it might be. It's just following in the footsteps of GE. I didn't do GE, and I looked at it, and I was like, how could I not make that kind of money on GE? It's ridiculous. When a big conglomerate carves out pieces, it's the classic, the parts are worth more than the whole story. It's just classic. The Dow is leading the market. Honeywell is a Dow stock. It's spinning off uranium investments, rare earth type of material investments. Now today it announces the next spinoff. It's going to be a quantum computing spinoff. And quite frankly, I want to own Honeywell and the spinoffs. Just go look at GE. It doesn't move as fast as, silver and gold or, crypto or whatever. But 12 months from now, we're going to look back and go, God, that was just easy money. We bought it perfect. It's continuing the spinoff phase. We're buying the spinoffs. We already added SOLS. Okay. We added that at around 52. It blew out yesterday. Okay. So we have Honeywell, we have SOLS. That's the strategy I'm following there in Honeywell. Low risk, high reward, and looking to own not every spinoff, but the spinoffs that I really like. I'm going to look to put them in the portfolio. SOLS already, and maybe that quantum spinoff whenever it happens. And it usually takes at least 3 months of consolidation. So it spins off, consolidates, and then starts to go, and that's when we get on it. The spinoff is not like a normal IPO where, you know, it's like a hot IPO and then it comes back down. They're not hot spinoffs. They just spin off, and then they do their base. When they break out of the base, you put the money to work. And GE is one example, but there's so many examples like this over the 35 plus years that I've been doing this, where a big company goes through this process and it's always a winner. That's why my head exploded when I looked back at GE and I was like, how did I not do that? I know that works. So we're doing it this time in Honeywell, and that's the announcement today. The stock's up a couple percent. Couple of highlights in the portfolio. It's time, and I titled this discussion this morning, it's time to own crypto. Okay, it's time to own crypto. So we've already got a Bitcoin position on that bottoming wedge. It broke out, it pulled back. We added to the position if we wanted to. We have a max position size on Bitcoin now. Had a great day yesterday. Let's see if it can add to it. Okay, I increased my size in Coinbase yesterday for any portfolio that needed it. Again, the buy trigger was here. It pulled back. You could add to it. Hopefully it's going to go. Now I added the next piece to the puzzle. All right, I put on a core position on Circle Internet, right? A hot IPO in a group that breaks out. It can just lead to phenomenal returns. So hot IPO, blew out, pulled back right into the lockup agreement that expired in November. It's made a tight bottoming pattern right in here. And so I put on a core position in the pattern, and I'm going to be finishing it off. I'm going to make it a full position if it closes above the 50-day moving average in that green box. Okay. And I do want some exposure. I know the Silver Fox has been doing a lot of great work on this group, which is crypto. Which, for those of you, who've been with me for a while and whatnot, it's incredibly rare that my dad would be talking about buying crypto. It's not something he does and didn't do in the past and all that kind of stuff, right? So I take what he's writing very seriously. He's been writing a lot on it over the last couple of months, trying to explain what's unfolding, particularly with Ether. So he has a lot of interest in what's going on with Ether. My investments right now are Bitcoin directly, and then the financial companies that benefit from whether it doesn't make a difference. They're agnostic, right? If crypto goes up, Coinbase goes up, Circle Internet. That's a, I think that goes up no matter what they do. But I think out of all the things he's been writing about, the asset that I find most compelling, I know someone's going to fall out of their chair when they hear this, but I think it's BitMine Immersion. So BitMine Immersion skyrocketed here because Tom Lee became the chairman of this company and turned it into a Michael Saylor type Ether company. They want to own 5% of all the Ether that's freely traded, and they want to stake it. I like the story better than what Michael Saylor was doing, right? Way back when. Because what they're creating here is actually an income instrument. It's a fascinating story. And I've made a lot of fun of Tom Lee over the years. So let me just tell you on the two levels. I think Tom Lee is just a constant bull, and he comes out and talks bullish all the time. And he's wrong constantly. And every now and then he's right. And somehow he gets a lot of airtime on CNBC and everyone thinks he's brilliant. So I laugh at that because he is brilliant. He knows the market goes up 80% of the time. So if he's always bullish, he's going to be right 80% of the time. So he's going to look brilliant. So like he comes on TV and he just makes these ridiculous proclamations. To me, it doesn't help me make any money. It doesn't help me invest. I don't know why people listen to him. What was I thought, what was his prognostication of Bitcoin? By the end of 2025, it would be, where was he? What was his price target? 200,000, 250,000 per Bitcoin at the end of last year. I mean, that was wildly wrong, but nobody cares. And they interview him because he has another great idea. And Bitcoin went up, right? So it just didn't get to his target. And I guess his target is a little more reasonable than, Kathy Wood, who thinks it's going to go to, 1.2 million Bitcoin. So, look, so you've heard me laugh at him a lot because I laugh at him because I don't want anybody on this desk to watch something on CNBC and then go make an investment off of something he says, because his game is just to be bullish because it's going to be right 80% of the time. It doesn't help you make money. All right. So put that aside for a minute. What he's doing here in BitMine Immersion, I think, is a really good idea. I really like it. I think it's a great way for me to get exposure to Ether. I don't want to just go buy Ether. But the idea of amassing a bunch of Ether and staking it and getting a return on it, I find that very attractive. So I'm going to give it a go down here. Whatever you choose to do in crypto, like anything else we do on this desk, but more so, you cannot pay up for crypto. Just like we can't pay up for gold and silver. We had to buy it right and never chase it. And we've worked ourselves into an insane position that's skyrocketing. So I guess you could have chased it, but you get my point, okay? There is no chasing these things because they reverse so fast you get your head blown off. So you've got to put the position on close to the stop. If you're chasing, the stop is so far away, you just get caught in the wood chipper of volatility, and you can't do that. So if I'm going to put on a position here, this is the location for BMNR. If it closes above the 50 and 200-day moving average, it's game on. Now, the Armor Algo gave a buy trigger right here. I didn't do it yet. I was focused on Bitcoin, Coinbase, CRL. But the last piece to the puzzle for me is going to be BitMine Immersion. So I'm going to have 4 stocks in the crypto space. That's all I need. Probably 12 to 15% of my portfolio, probably 15% of the portfolio will be in crypto. That's all the exposure I need. So Ether is up 3% this morning. BitMine Immersion's up 2.8% this morning. Closes strong today. I'm going to own that position. Now, I know Silver Fox is talking about Solerna. Okay, I'm not doing that. That there's a staking ETF on Solerna, and of course he's talking about owning Ether outright. I'm not going to do that. I think if I'm going to own Ether, I want a company that's going to be staking it. I'm not going to go buy Ether and go stake it myself. So I think this is the right way for me to play Ether and get some exposure. The rest of my portfolio. So I got some Ether, I got some Bitcoin, and then I got a couple of financial companies that make money no matter what's going on, as long as crypto is going higher, and that's Coinbase and CRCL. So if you're not sure about Circle, go look at our Substack. We wrote a report on Circle for you, I don't know, a couple months ago or something. I can post it in the Slack room again. Just go to our Substack. I'm assuming all you guys are already subscribed. It's a free subscription, and it's where we drop our research. That free subscription is where we drop research for stocks to watch. You're going to want to subscribe, obviously, you guys already do, for stocks to buy when we're putting money to work, what our stops are. But so I use that Substack as a place to say, this is all the research. It's archived. It's a simple way for all of you to get access to the research. And then from there, those are the things that are kind of on our whiteboard to help us understand where we want to go with our investments. And then we start putting the capital to work in meetings like this and on the live trading desk all day, which, by the way, I have to get to now. So I'm going to split Go to the live trading desk. I'll see you guys in a few minutes. I have a minute to wrap up. I know Nvidia was a stock Era's added yesterday to the portfolio, and then there's an interesting story this morning from IBD that Nvidia is setting up a good buying opportunity, and I don't disagree. That was the original Armor Algo entry. Then it pulled back. It's holding. If it can break out, that's a pretty interesting chart pattern. AMD, that's my favorite of those names. If Nvidia is going, then that pattern is the one that should be owned to me. That's the pattern. The blowout, the consolidation on top, the triple bottom, breaking of the downtrend. That's the one I would own. But close to that would be A-Labs. So if somebody still wants to focus on the data center space, it would be A-Labs. For me, it would be A-Labs and AMD. I don't know if they're going to make it into the portfolio. But they are on my whiteboard. They're on my whiteboard. So I'm still thinking. Okay, so those are a couple stocks top of the whiteboard that I'm thinking about. And just to wrap up, I went on some type of rant the other day about how much I dislike the Trump administration's decree that credit card companies can't charge more than 10% interest for the next 12 months or whatever. It's not that I don't feel for people who use credit and need help and all that. I do, I get it, but there's other ways to do it. Stepping into a business and summarily decreeing something from an administration is opening up a Pandora's box of disaster when a different administration from a different party is back in the White House. It's just a horrible precedent, number one. Number two, you can't do that to the banks that issue credit cards because they won't be able to run their credit book if you cap what they're doing, okay, of what they could charge. This, I get so annoyed that, when people get angry at banks for charging whatever. Hey, you know what? Don't borrow. Okay? The bank's not forcing somebody to go out there and, borrow. Okay, I mean, that's not, people are trying to make ends meet. It's a difficult economy. They have to borrow. I get it. But I'm just saying, I mean, people have 5 different credit cards. Maybe you just don't need that flat panel TV. I don't know. But I digress. I hope that doesn't sound harsh, but it just drives me crazy sometimes. It's not. Anyway, there are other ways to help those who need help than reaching in and saying you can't do something. And then today, so I've already explained this. We already talked about this. And then today, the CFO of Citigroup comes out and says they can't run a book like that if you just force them to use 10% as the limit. So what's eventually going to happen, like immediately is going to happen, is credit extension to those who are dealing with these. They won't be able to get credit. The CFO of Citigroup just said it this morning. I mean, he didn't need to say it. Anybody with a brain can look at it and see that. But now the CFO of Citigroup comes out and says it. Credit will collapse if you put that moratorium on rates arbitrarily. And, what's the next step? If Trump administration forces the banks to do it anyway, and then bail out the banks later when they have large losses? I don't know, but it's a total Pandora's box. All right. Listen, guys, market's gapping down this morning. A lot of geopolitical events that are causing insanity. So on the way out of this conversation, just step back, relax, and use the stop strategy. Just use the stop strategy. Don't care about the wild volatility during the day. Where are we at the end of the day? Where are we at the end of the week? Think for yourself, figure out your risk tolerance, and be the smart money.